I don't know if I'm going to talk about low interest rates in particular, but the overarching theme of this kind of planning, as with any gift planning, is the estate freeze. With any gift program, just taking interest rates off the table, we want to establish a low value for what's being given, and with the hopes that not only are we getting an asset out of a client's estate at a low value, but any future growth and appreciation will happen off the client's balance sheet. So I'm going to talk about 10 ways to use the IRS interest rates to kind of juice that up a little bit, leverage the gift. Now here are the rates. They're set every month by the IRS. The appropriate rate to use will depend on what you're going to be doing. The 75/20 rate is used for GRATs, QPRTs, charitable trusts, and annuities, and that's you use the rate in which you're making the gift. And the applicable federal rate is used for loan or sale transactions between related parties. So here they are. I could spend the rest of your morning and day talking about everything that's on this list. And we've many times in these seminars talked about GRATs and all these techniques. So I'm going to assume that you have a working knowledge of these techniques. I'll review them briefly and then stop and talk about particular things you might want to think about for some of these techniques. So the first is the intrafamily loan. The parent, very simple, parent will lend money to a child, take back a promissory note. We use the hurdle rate of the AFR, and which one you use depends on how long the loan is for. And if you do this transaction, the parent would die with the note, if it wasn't already paid off before death, freezing the value at whatever they loaned the money for, and then any future growth and appreciation in the proceeds would happen on the children's balance sheet. So one thing I just want to say, if you do this transaction, actually with all of them, please make sure, because you see the clients more than we do, that they actually carry through and follow through on the transaction that's been established. Make sure that the interest is actually paid by the children and that your clients report this interest on their tax return. This is a variation on this, what I just described. Either a loan or a sale occurs between the client and a grantor trust. Now, nothing is defective about this transaction. What it means is that the trust has been specifically drafted and crafted to be a grantor trust for income tax purposes, which means that all of the tax incidents, it's ignored for income tax purposes. And anything that happens in that grantor trust is reported by the grantor/client on his or her tax return. And because of this, any sale to the trust, there's no gain on sale. And when the interest or loan payments or installment payments are made back with interest, there is no reporting of that by the grantor, which means that you have even more assets that can perform in that trust off of the client's balance sheet. This technique also is attractive because what if you don't trust the children not to take the money, in the prior loan situation and dissipate it in some way? This way we can encapsulate it in the trust and make sure it's invested for growth over time. You will use the AFR rates, the 75/20 rates. Typically, we recommend a 9-year note of interest only with a balloon payment at the end. That means there's not that much load on the trust. It can use the funds, it's just pay interest, and they can use the funds to invest and perform. This month in December, that rate is 1.47%. That's the hurdle rate. So as long as that investment, whatever's in that trust, does better than that 1.47%, that growth will get out of the estate for tax purposes. Now the GRAT. The GRAT is still great. This is a great technique. I'll describe it in a simplified fashion. Your client transfers an asset to a trust and retains an annuity back, a very large annuity. It's so large that in essence, over the term of the GRAT, it will get back, the client will get back everything that he or she has placed into the trust, plus an interest rate, the 1.8% hurdle rate of December. So what that means is, to the extent that the assets that's in the trust performs better than that hurdle rate, that will stay in the trust, gift tax free. And the reason why it's gift tax free is because that annuity is so big, it's gonna zero out the gift. So again, with these low interest rates, many clients are just deciding to put a stock in their GRAT. And this makes sense for people that have used up their exemption completely, or want to make a gift of the growth, but not necessarily of the asset itself. So things to remember when you're managing these GRATs. As with any gift, identify valuation opportunities. Is there something that's worth a little less right now and makes sense to make a gift? If you're going to be using a set of stocks, separate them into separate GRATs so you can capture the performance of the winners and segregate the performance of the losers. If you find, as the GRAT's going on, and again, your boots on the ground with the clients, that an asset's performing really, really well, you've gotten that return. There's no reason to keep the risk in that GRAT that it's might go back down again. Your client can always exchange assets. So if I've got a stock in there that's gone up a lot, the client can take cash or another asset and exchange it, and then the client will take on the risk that the asset will go down, replacing in the GRAT, leaving in the GRAT, money, cash money, or some other asset that might be a little more stable, so we capture the gain. And then the remainder man of the GRAT can be children outright or anyone, but oftentimes it's a trust that is also a grantor trust, so that all of the income tax incidents of that trust are taxed to the grantor, and that enables really income tax-free growth within that asset itself. Here's a summary of just how the two techniques compare. They're not mutually exclusive. Which one you go with, and you could do both, and many of our clients do. A lot of times it depends on what asset is involved. For a GRAT, you do have that annuity load every year, so for assets that are less liquid, like closely held businesses or real estate, and in fact, many times we'll use a grantor trust that was seeded by a GRAT transaction to then go ahead and do some other things with the grantor trust. These next two techniques I'm going to cover pretty quickly because they're rarely used. I've never actually done one of these. And the next one, the private annuity, I think I've done twice in my career. They are not used because there's a lot of risk. They make sense for someone for a client who's ill, not likely to attain their life expectancy, but is not gravely ill, has not been judged terminally ill by a doctor. With the SKIN, the self-canceling installment note, by its terms, it ends at the client's death. So because that's kind of a good deal for the purchaser of the note, like the kids, you have to attribute a risk premium, you pay a little extra for that cancellation aspect, and in that connection you would need to get that appraised. For the private annuity, similar idea. So this is just like a commercial annuity. The client enters into agreement with family members that in exchange for money or an asset, the client will receive an annuity for their lifetime. Now, if you have a client that's not likely to achieve their life expectancy, that can be a really good deal for the kids. The risk is, as is with the SKIN, is what if the client lives beyond that life expectancy? So tread carefully with this because it will not work. If the client outlived their life expectancy, they're going to get back even more than what they transacted for. The Charitable Lead Annuity Trust, it's like a GRAT, but now we're going to fold a charitable intent into this. People talk a lot about this, and I don't see a lot of these either. They really make sense for someone who is charitably inclined anyway, and who doesn't need the money, and whose kids don't want the money. So what this is that the annuity, instead of being paid over to the client, is going to get paid over to the charity for a period of time, and the remainder will go on to children. And because you've got this charitable annuity, between the time the kids are going to receive the remainder, the gift to the children is quite low. And again, it's something that makes sense if you have clients that are otherwise charitably inclined. Charitable gift annuity. This is something that a client would enter into with a charitable institution. So it's simple, because the charitable institution has the infrastructure to either receive assets or money in exchange for an annuity that is paid to the client, typically for his or her lifetime. And the client will get a lifetime, a charitable deduction today for the remainder that's ultimately passing on to the kids based on, the actuarial tables. Again, it's relatively simple because you're setting it up with the charity, but there won't be any flexibility in changing the charity or changing the investments, because that's going to be managed with the charity. So for people who want a little more flexibility, they enter into this type of transaction with themselves by setting up a charitable remainder trust. And my partner, Patty Beauregard, is going to talk more about that. A qualified personal residence trust, so what that is that you or your client transfers a residence, either their primary residence or a vacation home, to a trust and retain the right to use it for a period of time. And depending on their age and the term selected and the interest rates, they can get a discount on the value of the gift of the house, because you're only calculating the value of the gift less the retained interest on the part of the client. Because interest rates are so low right now, you don't get as much bang for your buck in terms of that discount. But this technique is still viable. We look at it right now, given the low interest rates, for older clients. Clients in their 90s might set up a 2 or 5 year QPRT and get a significant discount on the value. Or if you have a younger client that, let's say, has a vacation home that they want to have continue in the family forever, they can use a longer term QPRT, 20, 30 years and when you go that long, you can get a significant discount on the value. So I just want to remind you, with QPRTs, they're relatively easy to set up. The real work comes when the term ends. I have had numerous audits with the IRS where they go very granular on how was this QPRT managed after it terminated. So I would encourage you to review this with your clients. After the term is ended and the house is now going to be typically continued in trust, the client needs to enter into a lease agreement with the QPRT and pay fair market rent, get an appraisal of that rent, enter into a lease, make sure it's an arm's length kind of lease, make sure you review the lease terms periodically to make sure they're still current, and make sure those rent payments are made timely and in the appropriate amount, because the IRS will ask for the checks. The final thing I'm going to talk about is a GRIT. GRITs were and are a technique in which you transfer an asset, investments, to a trust and retain the right to the income for a period of time. This was a great technique. It was so great that it was almost obliterated by Chapter 14. So the only thing you can use this kind of technique for when you use a house is when you're establishing these things for a close relative. However, the GRIT technique is still available for non-close or non-related relative. So you can benefit nieces and nephews or a non-marital partner. And this is a great way to transfer assets, again, on a discounted basis. It's the same idea as the QPRT, depending on your life expectancy and the term and the interest rates, you can discount what's transferred. So I recently did this. I had a 93-year-old client who had a girlfriend who he wanted to make, $1 million gift to. I said, hold on, I think we can do this better. So he established a 3-year QPRT. He transferred the $1 million in there. He retained the income from that $1 million. I don't remember what the discount was, but it was at least 25, 50%. And then when he survived the term, it went on to his girlfriend. And so we got a significant amount out on a discounted basis. Those are the 10 ways you can use interest rates to leverage your gift planning.